As homeowners wait on the sidelines for interest rates to come down and they sit back patiently waiting, not buying homes, you, ladies and gentlemen, have the ability to do one of two things. Either follow our business model or just wait and shelve your ideas, your dreams for another year until interest rates actually come down and until prices actually become a little bit more modest. If you're not buying cash producing assets, you're going to fail miserably long term when you try to retire in the future. Active income is great, but unless you get the asset game, the game of multi-unit real estate down, you will fail miserably. When people are broke, the biggest problem is they just want to make money. And so people go after making money. The biggest thing about making money is that making money is really not as hard as people think it is. One of the biggest things that I tell people, I said, the biggest issue isn't making money. How do you protect yourself from taxes? That's the big question. And so I want to tell people, I want to make sure that you understand that when you go in and you make money, because I'm going to teach you guys right now how to make six figures and how to put that into multi-unit real estate. Because in 1 year, 12 months, you can be building multi-unit real estate, 6-unit, 8-unit real estate. And here's the thing. Most people are out there knowing that they need to buy multi-unit real estate. Here's the caveat to that. There is no real estate on the market available for you guys. And so unless you get lucky on that 1Z, 2Z deal, possibly in some place across the United States, multi-unit real estate is over-leveraged and overpriced. It's been over-leveraged and overpriced since 2018. It's continued to get more over-leveraged and more overpriced over the course of the pandemic and post-pandemic. And now people are going out, and the people that have purchased those pieces of real estate, they can't get out of them because they're over-leveraged and values are too compressed. So those people that are going in trying to look for this stuff, they sit back and go, I'm going to get into multi-unit real estate. I learned how to underwrite it. I go, congratulations. What can you find? Oh, absolutely nothing. Because there is nothing on the market, ladies and gentlemen, that's available that makes sense financially unless you want to buy something in a 6 cap, raise capital for it, and just make a modest little piece of income. That's fine. But if you really want to play the game at a high level and you really want to make moves in your lives, then pay close attention to what I have to say over the next 20 minutes, because this, ladies and gentlemen, is what every single investor that aspires to crush it long term has to be doing. It isn't what they should be doing, it's what they have to do. Because if you're fix and flipping, you have a business that has active income, a lot of variables to it, and flipping sucks because you have this small little margin, over-leveraged houses that you go in, and now you have all these unforeseen costs, this time frame that you anticipate getting things done, and now you have to get all of that work done and then sell it for a premium. And when housing is expensive because the Feds told us they were going to lower interest rates in 2024, and yet they've done pot shit, zero to lower interest rates, the market has done absolutely nothing but sat still. As homeowners wait on the sidelines for interest rates to come down and they sit back patiently waiting, not buying homes, you, ladies and gentlemen, have the ability to do one of two things. Either follow our business model or just wait and shelve your ideas, your dreams for another year until interest rates actually come down and until prices actually become a little bit more modest, which in the near future, I don't foresee it happening because of the shortage of inventory. So let's create inventory instead of finding inventory. Let's create inventory instead of finding inventory. Here's how you scale in 12 months to multi-unit real estate. Ladies and gentlemen, you have to get experience building new homes. And I'm not talking about the vast majority of single-family homes that the abundance of people are going after. You have to hit the upper demographics of the upper middle class, okay? Here's how it breaks down. 74% of our population are buying homes less than $400,000, okay? You can compete with the masses. You can compete with D.R. Horton, Pulte, and these guys if you want. Because they're doing volume, you'll make anywhere between 30 to 60K per build, and they take just as long. If you divide that by a 6-month time period, the income sucks because I'm not working for $5,000 a month, and I don't recommend you do either. Or you can go out and you can hit target market, the ultra wealthy. That constitutes for 2% of our population, okay? Now, here's the thing. You build homes in excess greater than $1.5 million. You could go out and hit the ultra wealthy, and you'll make anywhere between $300,000 to probably $600,000 on now those builds potentially, okay? Depending on what you build at. That's great. That's a home run. But look at who you're target marketing. That's your audience. That's not a big enough audience. Your target market and going after a very minute amount of people. Yeah, your profit's good if you sell your house. This is where people go bankrupt because the mortgage is too high. They sit on the homes. They don't have enough people in that category to sell the homes, so they go broke. These people, ladies and gentlemen, there's just too much mass competition and the profitability is too low. So I tell people, get into the 24% of the upper middle class, homes between $500K to $1 million, okay? Now, that's where 24% of our population lives. Hundreds of thousands, hundreds of millions of people, guys, across the United States. That's enough of an audience where you can make money. In fact, 16% of all homes between this category, and this category are being purchased cash. Most of which are being purchased by these people here who have expendable income because they've paid off their home, they're retired, they're empty nesters, they've worked a 30-year career, or they're upper middle class money earners that are doing well. Both husband and wives making six figures, they're doctors, attorneys, or whatever, or self-employed entrepreneurs that are doing well financially. This, ladies and gentlemen, will bear you profits of between $100,000 to $200K, okay? So if you take that and you, in one build, guys, one build, you guys go in and do one build. I'll tell you, the sweet spot is between $700K and $800K. That is the sweet spot. Because in this sweet spot, you'll make close to 200 grand if you follow our business model. I'm not going to run you through this entire business model today. I just want you guys to understand that you guys can go back to my YouTube channel. You can find multiple videos, multitude of us documenting the process of like buying land, building houses. We have them all day long. In fact, at the end of this video, I'm going to recommend one to you where if you go back, you can watch an entire series of how to buy land, build houses, and make six-figure profits in this sector right here, okay? So today is not about this. Today is about understanding where you can go back, you can find that information, and you guys can rewatch those videos. In fact, when you do, hit hashtag repeat, letting me know that you have went back to watch the educational content that I put together for you guys for free to understand the in-depth how to do this. We've only been doing this business model for you guys. I've been doing this business model for over 26 years, but I did this for you guys over 5 years ago, and I probably have 20 videos on it. So we're going to let you guys do this. Now, once you do, just know that you're going to have someplace right around $150,000 in net profit, okay? Now, results, guys, are different. So look, guys, that is 85% of you guys will fail. And the reason that you guys will fail is because there's not a lack of information and education, there's a lack of application. And 85% of you guys won't apply any of what we're talking about here. Because if you do, you'll succeed. But the problem is that people will get excited. They go, oh my God, I'm going to go make six figures. I'm going to make millions of dollars doing this. And then they sit on their ass and do absolutely nothing, okay? And so understand that there's not a lack of educational content available. Application is the biggest determining variable. So what I tell people, ladies and gentlemen, is let's pallet this one thing at a time. You have to get off your ass. You have to implement a business model that works. Now, once you do that, here's what you get. One house, guys, one house. And I keep building them. But after your first house, I would scale into multifamily. Me knowing what I know now, because my only biggest regret is that I didn't scale big enough, fast enough. And I'm not talking about going into hundreds of units of apartments. Create inventory, just a little 8-unit, guys. Here's how you underwrite it, okay? Here's how you underwrite it. This is what this video is about. 8 units, okay? You go in, let's say that they're all 2-bedroom units, okay? You do 8 units. You're going to be nationwide with what's called RUBS, like you charge people for an application fee. You charge people for like late fees. You charge people for like laundry or a trash service, or you charge them for like pet deposits or having pets in there, or an extra parking space or a covered parking space. Those are called rental upgrades. They're RUBS. And so with base rents plus RUBS, you're going to get someplace right around that $2,150 a month. When you have 2-bedroom builds and you have 8 of them, $2,150 a month, that's $17,200 a month in gross income potential. Like that's your potential of what you can get. Now, that's $17,200 per month. You multiply that times 12 because everything you do in underwriting is annualized. It's not done by the month. It's done annually. So you multiply that by 12. That comes out to $206,400. That is your gross income potential. Gross income potential, GIP. Okay? Now, we take your gross income potential and historically, you have a 5% revolution on your properties every single month. And so if you just take this down to 95%, so if you take this down to 95%, we're going to look for your gross operating income. Okay, that's our gross income potential. That's the potential that it has, but there's always going to be variables like vacancies, right? Like we can't, that's inevitable. We're going to have that. So our gross operating income is going to be at 95%. So if we take this number right here and we go 2006, 400, and we divide that by 95%, so times, or not divide, we multiply it times 95%, 0.95, that gives us a gross operating income of $196,000, okay? Equals 196K, okay? Now, that's our gross operating income. Now, you're going to have property taxes. You're going to have insurance. You're going to have broken toilets. You're going to have landscaping that needs to be blowed, cleaned, and trimmed. You're going to have that stuff. And when you have that stuff, those are what's called expenses. You're going to have maybe an electrical bill for the exterior lighting, which is on your house panel. So you're going to have expenses to run that property. Now, typically, a property this small can function on about 25% management fees and expenses annually, including property taxes, insurance, all of that stuff. But let's say that it costs you someplace in the neighborhood of even 35%. Let's go high. Let's say that we're in a city where those fees are more expensive than they are otherwise. And so let's say that we go in and we're functioning on a 35%, on a 35% expenses. So expenses equal 35%, okay? So what is that? That number is going to be 196. So 196 times 0.35, $68,600. So that's $68,600 per year to run everything. That's all your expenses. Now, what we want, because we want to figure out value of this asset, is we want to go in and we want to figure out what our net operating income is, because we need that for our formulas, which I'll give you here in a second. So if we go in, we say, okay, net operating income equals your gross operating income minus expenses, okay? So now we're going to take our gross operating income of $196,000 minus $68,600 equals, so we're going to take 196 minus our expenses, 196, that equals $127,400. Let's just call it $127,000, okay? So $127,000, okay, is our net operating income, okay? Now, we want to take this right here. Take a screenshot of this, ladies and gentlemen. 8 units, 8 times 2150, 17,200 times 12, gross income potential, 206,400 times 95% is 196. You take your 196, you subtract that from your expenses, 35%, which is 68,000. We subtract that out. Our net operating income is $127,000 in annual income, your net operating income, okay? So $127,000, okay? That's our net operating income. So we have a net operating income of $127,000. Now, value, and you guys might be asking, well, Jerome, how do I build the damn thing? One thing at a time, guys. We want to figure out what the value of the project is first, right? Like, does it even make sense to build? Because if it doesn't make sense to build, why would you build it, right? Like, I want to teach you guys the underwriting. Let's go in and let's figure out exactly how much this thing is worth, and then let's back into the numbers and figure out, hey, can I afford to build it? Does it make sense to build? Is there money made? Is there money on the table for it to make it worth my time, my future, right? And so the value is the way you figure out value is you take your net operating income and you divide that by your cap rate. For those of you guys that don't know what a cap rate is, I have other videos on that. I'm not going to go through it in depth. You guys can go back and understand how to understand cap rates. But a cap rate is basically the return on investment if you pay cash for an asset. So if you bought this asset cash, that the percentage that you make is kind of like your return on investment in a stock. It's the amount you make annually on the purchase of that stock. So if you have like a 6% return on your stock, that's a 6% cap rate in real estate, okay? And right now, cap rates have to run in alignment with interest rates. You can afford to pay your mortgage, right? So we're underwriting these at 6% cap rates. So if we take an NOI, our value is going to be equal to 127K divided by a 6% cap rate. Okay, so now we take $127,000, we divide that by 0.06, 6%. That gives us a finished value, ladies and gentlemen, of $2,123,000, okay? So our value equals $2,123,000. Okay, 123. Let's just do 23,000. Let's write it all out. Okay, this, ladies and gentlemen, is our value. 2 million. We're going to reference back to this. So I want you guys to know where it's at in red. Okay, so we're going to do, our value is $2,123,000 in today's current market at a 6% cap rate, subjected to the rent rolls and a 95% occupancy as we have on the other page. It'll probably be worth more than that because I have a feeling that you'll be able to manage this for between 25 and 30%, which means our NOI goes up. When NOI goes up, value goes up because the higher the number that you're dividing, the higher the dividend, you're going to have a higher value, okay? But conservatively speaking, we want to make sure we have a conservative underwriting just in case the market shifts. What if rent rates drop? What if our NOI, what if our ability to run this at a 25 to 30% management is non-existent, and you have to hire a third-party property management company and they're more expensive to get a good one. Maybe you have to pay them an extra 5%. We want to be conservative, right? So worst case scenario, you have a value of $2.1 million to be able to function on. Now, what does this look like on cost to build? Let's look at this from a cost to build perspective, okay? So now let's go cost to build. We know we have 8 units, and each unit is 1,000 square feet, okay? They're 2-bedroom units. Most 2-bedroom units are in excess of 850 square feet. Let's be friendly with it, right? We're being conservative. Let's say they're 1,000 square foot each. So 8 units times 1,000 square foot units, okay? Square foot units. Now, we multiply that. That's 8,000 square feet that you're building. 8,000 square feet. Okay, now, one thing I know is the build cost, and I'm going to give you that right now because we're building these all over the place. We just finished stabilizing an asset that we built with general contractors' fees and everything for $152 a square foot. But we also know that we might have had some variable circumstances based on our experience in negotiation with trade labor that we may have been able to manipulate lower prices on than you can. So let's go in and let's say that it costs us $175 a square foot. Let's do $180 a square foot just to be really conservative and make sure that we can really build this. So our build cost is going to be equivalent to $185 a square foot. So we take $185 per square foot times 8,000 square feet. It's going to equal, so we take 8,000 square feet, 8,000 times 185. Okay, that's $1,480,000. Some of you guys are going, hey, it works. I can do it. We're not done yet. Okay, this is your cost to build. Okay, how about land? And how about debt? How you at your debt service? You got to take those two considerations in there. Okay, now, typically, we'll go in and spend about $15,000 per unit. So if you take 15,000 times 8 units, it's about $120,000 for the land. I will tell you guys that it's tough to find. The smaller you go on the units, the more expensive it is on price per unit. So let's say it costs you $20,000 per unit. It's 20 times 8, about $160,000. That's going to be more realistic. About $150,000 to find a lot where you can build multifamily. Now, here's what's cool. Is, if you guys ever go to like these downtown areas that you guys go into and you see like these cool little office buildings that turn into law firms, or these cool little office, old little houses that turn into little boutique restaurants, boutique hotels in downtown areas where they're like the historical houses that are right in the downtown area that are really distressed a lot of times, but then people go in, they fix them up and they turn them into commercial use properties. A lot of those are adaptive reuse projects that were residential at one point in time, but because of where they sit logistically to the city, they're promoting dense development. They need more commercial development in these downtown areas. So where you find these is a lot of infill lots, a lot of lots where maybe there was a duplex that already has the right zoning. You just level it and now you go more dense, right? So you could actually find really small lots. With a third of an acre lot, you can go in and build something like this. So you don't have to find these massive lots. And in some areas where density is promoted, you might be able to go in and even a quarter acre, build an 8-unit lot. Because let's take, for example, that let's say they allow for medium to high density of like 28 units per acre. So if you take 1 acre and you divide it by 4, you take 28 units divided by 4, that's still 7 units on a quarter acre. So I would go a little higher and maybe a third of an acre And if you look in that standpoint, you're going to spend about $160,000 for land or a distressed home that you need to scrape and level, okay? And so when you guys go in and you do this, the land cost is going to cost you someplace right around $160,000, okay? So that's going to cost $160K. That's going to add to your cost. And then you have debt service on those two things. You could build one of these in 6 months, okay? From the time you start construction, your debt service is going to start on the land the second you buy the land. If you do a delayed close or you do owner financing, you can back up the interest to the backside of that. So let's say you own the land for an entire year because it takes you 6 months to get building permits, then it takes you 6 months to actually build the asset. So $160,000, and let's say you have high interest at like even 9%, $160,000. So we have 160 times 0.09. That's going to be for a year. Okay, sorry, 160 times 0.09. That's $14,000 in debt service, okay? So we're going to have about $14,000 in debt service for the land, $14K. And then we have this build cost. Now, here's what's cool about the build cost is that it appreciates in sections. What happens is they only will charge you interest on what you've taken, not what you actually have in lending capabilities. So it's actually about 30% of the entire annual interest rate. So let's say, for example, you have this construction loan, you have a 1.4 million, 1 million, you can only have 80% of that, okay? Well, let's take the whole thing because you're going to have debt service from someplace, private money or from institutional money. So we have 1,480,000, and you're going to have that, let's call that 8.5% times 0.085, okay? Now, the annual interest rate on that's $125,000. So if we take 30% of that, so times 0.3, that's $37,000 in debt service because you're not getting charged that $1.5 million right off the bat. Now, that's on an annual basis. It's going to take you 6 months. But let's say it takes you some time to stabilize. Let's just go ahead and utilize that $37,000 plus the $14,000. So we take the $37,000, okay, because it's going to be about $37,800 for the build, okay? We take these two debt services, and we're going to have plus 14. That's going to be $51,800, okay? So this is called $52,000 in debt service. Okay, now, when we go in, guys, we're going to add these three up. We're going to take our $52,000 plus we're going to take our $1,480,000, 1, 2, 3, plus we're going to take $160,000 for the land. That's $1,700,000, okay? So our total cost to build, remember we need this number here, okay? Our total cost to build is $1,700,000. $1,700,000, okay? That's our total cost. Okay, now, that's our total cost to build. Our value equals $2,123,000. Okay, now, we're going to have to stabilize this, okay? We're going to have to stabilize this. We can afford to build it. Or can we? We're still not done yet, guys. Understand, there's more to this. I want to make sure you guys understand this. You guys set yourself up for success. Okay, so we go in, and that we can only get an 80% loan to value on this number right here, okay, LTV. So now we take in $2,123,000 times 80% times 0.80. They're willing to lend you $1,700,000. That's your stabilized loan, okay? You can go in and you can build this, okay? Now, here's the thing. You can go in, you can buy your land, you can build one house, and you can collateralize that against the actual build. Because what ends up happening on these builds is that once you go in and you buy the land for, let's say, $170,000, once you entitle that land, the land value goes up exponentially, and it may be worth $40,000 to $50,000 per unit based on lending and values of land and how the banks look at it. So if you have 8 times $45,000 per unit, that land is worth $360,000. So if our cost to build is this right here, our cost to build, we go in and we say, okay, 1,480,000 times 0.20, that's $296,000 on the 20% loan to cost. So your loan to cost is 80%, what the bank will give you. You need to come to the table with $296,000. That's $300,000. So if the land itself is now worth $360,000, so it's $45,000 per lot times 8, that's $360,000. do you have enough collateralization to get this loan? Now, you can't look at this like a home loan. And the biggest problem with people today is you guys have a bunch of bullshit education from 13,000 hours of school that doesn't teach you this stuff. They don't teach you how banks work. What I'm telling you guys is you take land at a wholesale price that you buy non-entitled for $160,000. You entitle it for 8 units. The land now becomes worth $360,000. When the bank looks at that land, all you've done is you built one house. One house, you buy this land cash. Or you own or finance it. Doesn't matter. Now, you go in, if you buy that land cash, you collateralize that land against your build, you need $300K to be able to get a loan. You already have the land because you bought it. You collateralize the land, the 360 value against the build cost. This is what you need to actually build the property. Now you go in and you need $60,000 in interest reserve because this is your interest, right? So the other $60,000 is your interest reserve to pay the debt on this to build the property. So you take a $300,000 land value, you take $60,000 in interest reserve, that's $360,000. Now you can build this with no more cash out of pocket than what you've already made just building one house. Now you have a property that you own that's worth $2.1 million. Here's your loan amount. Now you cash flow for the rest of your life. Here's what's cool. You can take this, ladies and gentlemen, and you can take 80% depreciation minus land value because land never depreciates. So if you take $2,123,000, subtract out the $360,000 land value, that's $1.76 million, okay? You can take 80% of this through cost segregation in 1 year, your very first year, in a tax deduction. So times 0.8, that means you could take $1.4 million, not tax deferred, tax depreciation. That, ladies and gentlemen, is tax-free money. This tax deduction, that's a tax deduction through a cost segregation. And this is what we call bonus depreciation. This is loaded, guys. Just understand that you can take this your very first year. This goes against your earned income. So if you're working a job, you don't have to pay taxes until you make $1.4 million in net taxable income, and this never, ever expires. And so the benefit, if it's only taxes in itself, you won't have to pay taxes, plus that property will cash flow for you for the rest of your life. Ladies and gentlemen, when I tell you guys that an 8-unit apartment complex is life transformational for the vast majority of the United States, imagine earning $1.4 million of net taxable income in your life and not paying zero taxes. That'll increase your revenue right there in itself with what you're currently doing just by owning this asset by over 35% for the vast majority of you guys across the United States. If you live in California, close to 50%. So ladies and gentlemen, one 8-unit apartment complex is life transformational. What if you continue building these? What if you continue building houses? Education is key. Ladies and gentlemen, this is how you go out and you compound your success. This is how you go out and build an 8-unit development. This is what we'll be teaching in Dallas on June 22nd, 2024. We'll be teaching you guys how to do this in depth. If you guys want to spend the entire day with me breaking this down in groups, I have an intimate group of less than 200 people that we're going to be putting together in Dallas on June 22nd. I'm going to drop a link in this comment section. If you like this content, you want more information, more content just like this, then damn it, click and subscribe to our YouTube channel. Click and subscribe right now and pound that thumbs up button. You know why I need you to pound that thumbs up button? Because we crushed it for you. This, ladies and gentlemen, will change your life. I just crushed it for you. Give me that thumbs up. Click and subscribe. I'm going to put a video at the beginning of this video explaining you guys how to buy land, build houses, make over $150,000 if and only if you get off your ass and implement the process that I've been doing for over 26 years. Thank you. God bless you guys, and go out and compound your success.